Hey, it's Owen here with Owen Finance, your gateway to smarter investments, sharper financial insights, and also the ever evolving world of crypto and much more. Ready to level up your financial game? Let's dive in. An investment portfolio is a bit like choosing outfits for different occasions. You want to look great at work, feel comfortable on weekends, and still be ready for that fancy dinner someone invites you to out of the blue. In finance terms, that means having the right balance of assets so you're prepared for whatever the market decides to throw at you next. Some people imagine they'll outsmart the market by day trading in their pajamas with a half eaten bag of chips. That might be entertaining to watch, but let's just say it's no guaranteed path to long term success. Before throwing any money into the markets, it's crucial to figure out why you're investing and for how long. If you dream of an early retirement filled with luxury cruises, your strategy might differ from someone who just wants a down payment on a condo in the next few years. Setting clear goals and knowing whether you're in this for 5 years, 10 years, or a lifetime will guide you in choosing assets. A short term goal usually pairs better with safer instruments, while a long horizon can endure more volatility if it means a shot at higher returns. Getting the balance right among different categories of investments is a bit like deciding how many suits, t shirts, and fancy shoes you need. It's known as asset allocation. Some prefer a bigger chunk in stocks if they can handle more risk. Others might lean on bonds for stability or stash some cash for emergencies. Every category has its pros and cons. Stocks typically aim for higher returns, but can feel like a roller coaster ride when the market gets moody. Bonds tend to be more stable but less exciting, and if you hoard too much cash, inflation might nibble away at its value. To reduce risk, it's important to spread money across various sectors, regions, and even currencies. This is diversification, the fancy word for don't put all your eggs in one basket. If you bet everything on one high flying tech company, you might be dancing on the ceiling one day and sobbing into your pillow the next. Diversifying can involve multiple industries like technology, healthcare, consumer goods, and energy, so that if one sector takes a hit, others might hold strong. It's not a guarantee against losses, but it can help cushion the blow. Stocks play a major role in most portfolios because they offer growth potential. Some are dividend payers, so you get regular cash distributions, kind of like having a side hustle that pays you just for holding onto the shares. Others are growth oriented and might not pay dividends, but aim to shoot up in price over time. Figuring out how much of your portfolio to dedicate to stocks depends on your appetite for risk. If a 20% drop in a week sends you into a panic, you might want to ease off the accelerator. If you can handle the adrenaline rush, maybe you tilt more towards equities. Rebalancing is the act of bringing your portfolio back in line with its original targets. Imagine you decided on 60% stocks and 40% bonds, but after a market rally, your stocks soared to 70%. It may feel awesome seeing those gains, but you're now riskier than you intended. Rebalancing means trimming a little off the top where you've gained and reinforcing positions that have lagged. It might sound counterintuitive to sell winners and buy losers, but that's how you maintain your desired risk level. There are a couple of ways to decide when and how to rebalance. Some people pick a schedule, like doing it once a year, so they don't constantly fuss over the fluctuations. Others set thresholds, say, if an asset class drifts 5% or more away from the target. There's no perfect approach for everyone. The idea is to remain disciplined and avoid making emotional decisions based on headlines. Ever seen those breaking news alerts predicting the end of the world if stocks drop 2 days in a row? That's when a systematic plan helps stop you from acting out of fear or greed. Let's take a practical example. You start with 50% in a diversified basket of stocks and 50% in bonds, planning to check in annually. After 1 year, let's suppose stocks have climbed to 60% of your portfolio's total value while bonds sit at 40%. You might decide it's time to sell enough stock to bring that portion back to 50% and then allocate the proceeds into bonds. If things go the other way and stocks plummet to 40%, you'd do the opposite, buying the dip to restore the balance. It's a systematic approach that helps you buy low and sell high, at least on average. Tracking your investments can be a headache if you don't have the right tools. Fortunately, there are plenty of online platforms or even apps that update your portfolio in real time. You can also use spreadsheets if you're into that level of control, and maybe a little masochism. Some brokerages automatically show you allocations by asset class and sector. The trick is consistency. Check in once in a while, not every 5 minutes. Otherwise, you'll drive yourself crazy or end up doom scrolling and second guessing every move. An overlooked part of successful investing is handling your own psychology. Ever notice how people boast about their winners, but stay awfully quiet about their losers? Or how the internet is full of stock tips from gurus who say they found the next 10x opportunity, but conveniently never mention the 5 times they were dead wrong? Emotions can lead to bad decisions, like chasing hype or panicking during a downturn. Having a clear plan and knowing when you're going to rebalance helps you keep your cool and not let headlines push you around. Nobody's perfect, and that extends to building and rebalancing a portfolio. A common slip up is making changes too often, thinking you can time every little market wiggle. Another is ignoring your portfolio for so long that it morphs into a monster, with one asset ballooning to half your entire net worth. It might also be tempting to follow the herd into certain can't lose sectors. History shows those tend to lose eventually, or at least get smacked with reality in a cyclical downturn. Better to learn from other people's mistakes than to star in that horror story yourself. There are special occasions when you might tweak your strategy. Maybe you're about to retire, or you got a sudden windfall, like an inheritance or a lottery ticket you found in your winter jacket. If you expect a recession or the potential meltdown of your favorite crypto, you might reconsider how much risk you want. That doesn't mean panic selling everything the moment there's a scary headline. It's more about making thoughtful adjustments as your circumstances evolve. Life changes, and so should your portfolio. Alternative and complementary assets can spice things up if you're feeling adventurous, like tossing some cryptocurrency or crowdfunding into the mix. They can bring in big gains or big losses, depending on the timing and the luck of the draw. Some people dip their toes in real estate or farmland or even invest in whiskey barrels. Yes, that's a thing. These alternatives can add diversification, but it's also easy to get burned if you don't understand the risks. Approach them like you would a very hot pepper sauce. A little might make things delicious, but too much and you're calling the fire department. Monitoring your portfolio's performance is about more than just bragging rights. You want to see if your current allocation still matches your goals, whether you're underperforming benchmarks, and how much volatility you're experiencing. It's useful to keep track of your returns adjusted for risk. If you're sleeping soundly at night and your portfolio's returns are reasonable, that might be success right there. If you're biting your nails during every market dip, maybe it's time to adjust. Overly dramatic financial news channels thrive on fear, so step back, look at the data, and remember your original plan. It all comes down to consistent practice. Know what you're aiming for, allocate your assets wisely, spread out your risk, and rebalance on a schedule or threshold that makes sense for you. The biggest irony is that many people are more diligent when buying a car or picking out a new phone than when putting their life savings into the market. Don't be one of those who end up with a random portfolio that only makes sense in hindsight. A thoughtful plan and a willingness to adjust over time can go a long way toward keeping you on track, even when the markets pull wild stunts.
Thank you for watching. If you liked the video, don't forget to give a like and subscribe to support us. If you are interested in our premium content, please also visit our Patreon. You can find the link in the description. Thank you, and take care of yourself and your finances.